Good evening, everybody, and thank you for joining us for the Federal Budget 2018 update. My name is Julie Sabaris, and I'm the Financial Planning Lead here at MD Management, and I will be your moderator this evening. I'm also joined by some very knowledgeable presenters. First off, I have John Feely, the Vice President of Member Relevance from the Canadian Medical Association. I'm also joined by Angela Campbell, Assistant Vice President of Taxation Services, as well as Lowell Thiessen, Wealth Lead here at MD as well. So just a little bit about MD Management. So we are more than just investment management. We do cover your full wealth management needs, including financial planning, investments, insurance, estate and trust, banking and borrowing, as well as medical practice and corporation. So just before I turn it over to Angela to get into our presentation, just some housekeeping items. So if you do have a question, please use the Q&A box and direct your question to all panelists. If you are not able to use the question and answer box, please send an email to mdwebinars, all one word, at cma.ca. And we have people here waiting to answer your inquiries. Also, please feel to submit questions throughout the presentation. However, we will not take any questions until the end of the presentation, and we will answer as many questions as possible at that point in time. We'll also email you a link of the presentation as soon as it becomes available on our website. So without further ado, I'm going to turn it over to Angela.
Thanks, Julie, and thanks to all of you for joining this evening. I'm going to spend the next 15 minutes or so recapping some of the tax changes introduced in the 2018 federal budget, as well as provide a refresher on where we currently stand with respect to tax changes impacting private corporations that were introduced last year. As you likely recall, in July 2017, the federal government released a consultation paper that included some significant tax changes impacting private corporations, including tax changes that limited the ability for business owners to split corporate income with family members through dividend sprinkling. It also introduced tax changes that would restrict circumstances where a corporation could effectively convert its dividend income into capital gains. And finally, it introduced a whole new framework for the taxation of passive income earned on passive investments held in private corporations. The response to these changes was immediate and loud. When the consultation period ended in October, the government had received over 20,000 responses. Within the following weeks, it announced it would completely drop the tax changes impacting the conversion of income, promised to simplify the proposed income sprinkling legislation, and promised to deliver the first detailed legislation related to the taxation of passive income in its 2018 budget. So where are we today? Well, in December, the government did deliver on its promise to simplify the legislation impacting income sprinkling by releasing a new version of the proposed legislation. To refresh your memory, income sprinkling refers to the payment of dividends to multiple shareholders of a corporation, which can include spouses and other adult family members. Income sprinkling provides a benefit to a family when spouses and adult family members are in a lower tax bracket compared to the shareholder or business owner who might otherwise have received the dividend. In its July consultation paper, the government expressed its concern that this practice was unfair and introduced legislation that would require that a reasonableness test be applied to any dividend paid to spouses and adult family members. Provided the reasonableness test was met, the dividend could be paid without any impact. If the reasonableness test was not met and the dividend was paid anyway, the recipient would be taxed on the dividend at the highest marginal tax rate, essentially a punitive tax. In mid-December, the government released its new version of this proposed legislation in order to simplify who these new rules would apply to by introducing 3 key exceptions, which will result in these proposed tax changes not applying to many small business owners. The downside of these revisions is that we expect that the majority of you, as incorporated physicians, will not qualify for these new exceptions for at least the time being. So what are the exceptions? Well, the first I'll mention is the one that incorporated physicians will eventually have an opportunity to meet, and that is that the new restrictive rules on income splitting will not apply to payments made to a spouse if the primary business owner is age 65 or older. This means that once you reach the age of 65, you'll be able to split corporate income with your spouse without concern for these new rules. The government made this concession in recognition of the fact that all pension income is currently eligible for income splitting in Canada, and that many small business owners use corporate savings to fund their retirement. The second exception applies if the business can be considered an excluded business to the family member receiving the dividend. An excluded business includes one where a shareholder has worked in the business for at least 20 hours a week throughout the current year or within any 5 previous years. It's possible that your spouse and adult family members may be able to meet this test if they're performing regular functions for your professional corporation, but we do expect that the majority of physician family members may not be able to meet this one. The third exception introduced in December considered whether the shares owned by the family member would be considered excluded shares. However, shares of professional corporations are specifically singled out as not meeting this test. If none of these 3 exceptions are met, then the dividends paid to family members are subject to a reasonableness test that considers labor and capital contributions of the shareholder, along with the risk that has been assumed and historical payments that have been paid. If the reasonableness test is not met, the dividend will be taxed at the highest marginal tax rate. So you may be wondering, what's the status of this legislation today? Well, the legislation is currently in proposal form, meaning it has not made its way through the legislative process and is technically not considered law. However, the proposed legislation will be effective as of January 1 of this year, regardless of the final timing of its enactment, and the government recommitted in the recent federal budget to having this legislation enacted into law this year. Now let's take a look at passive investment income. Prior to the federal budget release, we were expecting it would contain the government's first draft of legislation that would fundamentally change the way passive income in private corporations would be taxed. The theoretical framework for these changes was introduced in the July consultation paper and was meant to eliminate the deferral advantage of incorporation by effectively increasing the tax rate on passive income to rates approaching 73% in some cases. This new system was expected to be extremely complex, given that the government planned to apply it on a go-forward basis only, and also indicated in October that it would allow up to $50,000 of passive income each year to be taxed under our current tax rules. Since October, we've all questioned how the system was going to work, how investments were going to be tracked, what would be included in grandfathered assets, when this new system was going to be effective, and so on. The level of uncertainty has been extremely high. So what did the budget deliver with respect to passive income? Well, the government did not deliver what we expected at all. In fact, it completely scrapped developing its new framework of taxing passive income and instead introduced a new test that will impact a corporation's ability to access the small business tax rate. Essentially, a corporation's annual $500,000 small business limit will begin to be phased out as the company's passive income exceeds $50,000 and will be fully eliminated once passive income exceeds $150,000. So to the extent a corporation has built up a significant investment portfolio generating over $50,000 in passive income, the government may not allow the company to fully benefit from the small business tax rate, which was originally put in place as an incentive to help small businesses reinvest in themselves. It's important to keep in mind as we discuss this change that the small business tax rate can only be applied to active business income earned in the corporation, essentially your professional or business earnings. Passive income relates to the income earned on your investments and is currently subject to much higher corporate tax rates. And although this change will mean that some incorporated physicians could pay more corporate tax up front on their active business income, we will introduce some concepts and strategies that may help minimize the impact. On the positive side, we finally have some certainty as to what tax rules will apply going forward, and the change is much simpler than was originally contemplated and will significantly reduce the compliance burden compared to the proposed framework introduced in July. You may be wondering if this new test impacting access to the small business limit will also impact the taxation of passive income earned in private corporations. Well, the answer is no. All passive income generated in private corporations will be taxed going forward no differently than how it has historically been taxed. Integration has been preserved for passive income, and there will be no rates approaching 73%. You may also be wondering how this new phase out of the small business limit will work. As you can see from the table in this slide, going forward, the small business limit for a corporation will be reduced by $5 for every $1 in passive income over $50,000. The small business limit will be reduced on a straight line basis until passive income reaches $150,000, at which point a company will no longer have access to the small business tax rate. So what does this mean? Well, essentially, The level of passive income in a corporation will be used to determine what tax rate will apply to active business income or professional earnings. The more assets retained in a corporation generating investment income, the less access the corporation will have to the small business tax rate for professional earnings. There are a few other important points when considering this new limitation. The first is that this calculation is an annual test that uses the passive income of the preceding tax year. So each tax year, a private corporation will determine its access to the small business limit by considering its passive income in the prior tax year. A corporation with high passive income in one tax year may have its small business limit reduced in the following year. Its passive income in that subsequent year will be used to calculate its small business limit for the year after that. So if passive income is lower in the following year, it is absolutely conceivable for a corporation to lose access to the small business limit in one year and regain it the next. You have to complete the calculation each tax year. The second factor to consider is that the annual $500,000 small business limit must already be shared among all companies in an associated group. On top of this new limitation also considers the combined passive income of all companies in the associated group, so that the group's $500,000 small business limit begins to be phased out when the group's passive income for the preceding year exceeds $50,000. This means you cannot move all passive assets to a holding company and preserve the small business deduction in your professional corporation. The associated company rules can be complex, but essentially two companies are associated if they are controlled directly or indirectly by the same person, or if companies are controlled by related persons where there is some cross-ownership of shares. The tax changes introduced in the budget also introduce an anti-avoidance rule to deem corporations to be associated with one another if they wouldn't otherwise be, where passive assets are loaned or moved to another corporation controlled by a related person. Keep in mind that dual doctor families, where each spouse is incorporated separately and where there is no significant cross-owner of shares, well, they are not considered to be associated, and therefore each company should have its own $500,000 small business limit and would calculate its potential phase-out of this limit using its own passive income only. Finally, this new limitation will be effective for a corporation's tax year beginning in 2019. However, since the calculation uses the passive income of the preceding tax year in its calculation, this would mean that for a corporation with a December 31st year end, its passive income earned in 2018 will impact its access to the small business limit for its December 31st, 2019 year end. You may be wondering what happens if a corporation loses access to the small business tax rate. Does it mean that the corporation will ultimately pay more tax? Well, not necessarily. Theoretically, the concept of integration provides that the same tax is paid whether a dollar of income is earned personally or through a corporation. If you lose access to the small business tax rate on active business income, you're required to pay tax at the general corporate tax rate. Paying tax at the general corporate rate means you are paying more tax in the corporation up front, but will also pay less tax when the money is extracted in the form of a dividend. This is because income that has been taxed at the general corporate tax rate can be paid to shareholders as eligible dividends, which are subject to lower personal tax rates than non-eligible dividends. Income that has been taxed in a corporation at the small business tax rate can only be paid to shareholders as higher taxed non-eligible dividends. Let's take a look at a visual. This slide is meant to illustrate how the concept of integration can be applied to your professional earnings, whether taxed personally or corporately. Keep in mind that this visual is meant for illustrative purposes only, and that actual personal outcomes can vary significantly. The first column in this slide represents that professional income earned personally at the highest marginal tax bracket will result in personal taxes paid of approximately 50%, leaving you with the remaining 50% as after-tax income. Contrast this with earning your professional income through a corporation where it can access the small business tax rate, which is around 13% in most provinces. In this scenario, 37% in tax can be deferred until you distribute the earnings to yourself and pay the personal tax on the dividend. As you can see, the total corporate and personal tax paid is virtually the same as earning the income personally. However, to the extent that you don't need the money right away, that personal layer of tax can be deferred indefinitely by leaving money in the corporation. If a corporation loses access to the small business tax rate, the active business income will be subject to the general corporate tax rate, which is around 27%. As you can see from the column to the far right, this means that with 27% tax paid up front, the deferral advantage is reduced by 14% compared to income taxed at the small business tax rate. However, it still offers a significant deferral over paying personal tax up front. The key concept is one of timing. This change introduced in the federal budget could accelerate the payment of tax to an earlier time frame if the small business tax rate is no longer accessible, which could result in less money to invest in your corporate passive investment portfolios over time, with the impact of compounding investment returns could result in less accumulated wealth. It's also important to keep in mind that integration is not perfect in reality, and in most provinces there is a cost to earning income through a corporation at the general corporate tax rate compared to earning it at the small business tax rate. Although this cost is less than 2% for most provinces, it's notably higher in others. For example, the tax cost of imperfect integration is over 3% in Manitoba, 5% in Nova Scotia, and over 8% in Newfoundland. In these provinces, there will likely be an increased incentive to manage the level of corporate income taxed at the general corporate tax rate. So now that we know that the level of passive income in a company will impact its access to the small business tax rate, many of you may be wondering about passive investment income. How will this be determined each year? What's included and what isn't? Well, generally speaking, you will want to think of it as the realized investment income earned on your passive investments. However, the technical term for passive income that will be considered in the calculation is Adjusted Aggregate Investment Income, or AAII. A company's AAII will include interest income and foreign income, dividend income from unrelated corporations, current year realized taxable capital gains and losses, passive rental income, as well as income from savings in a life insurance policy that is not an exempt policy. On the other hand, AAII will not include net capital losses carried over from a prior year, intercompany dividends from a connected corporation, and gains and losses from assets that are used principally in an active business. There are a couple other items worth mentioning when you consider the definition of AAII. The definition includes realized income only, so therefore unrealized gains and losses are not included. It also includes taxable capital gains and net capital losses, and this means that the 50% inclusion rate is applied to capital gains and capital losses in the calculation. It includes the passive income on all passive investments of the companies in the associated group. There is no ability to exclude passive income on pre-existing assets. It's conceivable that AAI may be managed to an extent by investment choices that limit the amount of realized income in a particular year, although I am not suggesting that investment decisions be made solely for tax reasons, and I'll let our financial planning expert elaborate on planning ideas. You may also be wondering if there are other ways to manage or limit the impact of this change from a tax perspective. Well, the first point to keep in mind is that you need to consider the amount of two different types of income in your corporation to determine the extent to which you are impacted. For example, if your professional corporation generates $200,000 in net professional earnings, you will only need a small business limit of $200,000 to have your professional earnings subject to the small business tax rate. This means that your company could have a passive income of $110,000 before your small business limit is phased out to an amount below $200,000. Another consideration is that one way you could potentially manage the level of active business income remaining in your corporation is with the payment of salary, as any salary payments you make count as a deduction from your active business income. I expect that there will be a renewed interest in looking at the salary dividend compensation mix going forward as you work with your tax and financial advisors to determine the optimal level of professional earnings to leave in your corporation. And with that, I'll turn over to Lowell to discuss financial planning considerations and look forward to any questions you may have at the end of the session.
Actually, before we hand it over to Lowell, I'm just going to turn it over to John for the CMA advocacy campaign update.
Thanks, Julie and Angela. So as Angela mentioned, the reaction on July 18th, 2017 was quite loud, in fact, extremely loud, from the membership and across all small businesses. CMA quickly got out there and denounced the the proposals. In addition, we worked actively with the Canadian Federation of Independent Business to help establish a coalition, and known as the Coalition for Small Business Tax Fairness. It started with just a handful of groups and rapidly grew to over 75 organizations, and a real mix of professional groups as well as farmers, fishers, small convenience store owners, and we've been able to use that to great effect. In terms of more recent history, if you will, we were very active pushing the government through a number of meetings with the MPs and the minister, as well as providing a technical brief to government, one of the 20,000 that the government had received. And with thanks from our friends at MD Management to help us with the meetings at the Senate Committee, as well as the Department of Finance Standing Committee. We also responded in November and December with reactions to the proposals that were announced in the fall. We were very active on the file. I think one of the things that we also helped to create a great and strong case for us was the amount of member engagement. We had record high levels of high engagement from members, over 14,000 letters sent to MPs, and I think that really resulted in a lot of pressure from the backbench to the Minister of Finance, and we really appreciate your engagement on that. The other thing that we noted, we were for the first time in our history, the CMA was excluded from the budget lockup. So I think that will gives you a sense of the amount of consternation that was created by the CMA activity on this file. Finally, work continues. The coalition is as strong as ever. We just had a meeting earlier this week. We're submitting another letter to the Minister of Finance and all MPs, outlining our concerns with the proposals and are recommending some advancements or changes in the proposals in relation to income splitting, looking for an exemption for spouses from the TOSI rules, as well as looking at from a passive investment perspective, for example, including an escalator on the passive income over time. So I think that to let you know that the work continues. It's ever important to express your concerns to your local MP. I think we have made a very strong and collective difference when you consider where the government started in July of 2017. And I am going to pause there just to thank you all, thank our friends at MD, and pass it to my colleague Lowell Thiessen from MD Management.
Thanks, John. And I'm following up on Angela, so thank you, Angela, too. The 2018 budget effectively scrapped the approaches that finance had been considering and replaced them with a new method. The good news is that the new approach is simpler and of less consequence than last year's proposals. Unfortunately, there are consequences that need to be factored in when deciding whether to incorporate and for practicing physicians with a corporation. Big picture though, if the original proposal was a stab to the heart of using corporate deferral to boost retirement savings, the new method is a kick to the shins. And I want to also offer my kudos to the Canadian Medical Association and those of you who called and wrote in. Your efforts helped substantially reduce the consequences to corporate passive investing. Let's start with physicians who aren't impacted. The consequence of the new approach is that access to the small business tax rate is reduced. The small business tax rate is an important part of corporations which have active business income. So, where there is no active business income, it does not matter how much passive income there is, there's no consequence. This should cover the majority of retirement and estate scenarios. It probably doesn't hurt to double check that there are no consequences, but the reality is that retirement is like a get out of jail free card in terms of escaping the ramifications from the new corporate passive investment rules. Even better than the income sprinkling version, there's no age limit. For perspective 1, let's focus on the incorporation decision. Jennifer is a 30-year-old physician earning $350,000 per year who is considering the incorporation of her medical practice and had planned to save $75,000 per year within that corporation. Jennifer represents average physician gross income with healthy but not high corporate savings levels. If her compensation method is dividends and she earns a 5% fully taxable return on her corporate investments, the new rules will impact Jennifer's plans in mid-career, around age 45. Should she make no changes, the increased corporate taxes will amount to almost $500,000 by age 60. And the negative impact to her corporate portfolio would be over $500,000. Some notable points. Being subject to the general corporate rate is still better than being subject to top personal tax rates. So this is a reduced deferral of benefits in the corporation, not an elimination of tax deferral. And secondly, the consequences will be at least partially offset by the reality that Jennifer's corporation will be building grip when it is exposed to the general corporate tax rates, which means she will have access to eligible dividends, which should reduce her personal tax. Let's keep everything else the same, but Ken is 45 years old and has already built up more than $1 million in his corporation. While Jennifer's situation may well face greater overall impact, she has more time to manage around the challenges. For Ken, the ramifications of the change could be immediate, or at least nearly immediate, as the new rules take effect for corporate year ends in 2019. That means he needs strategies that work quickly and have higher impact. Notably, like Jennifer, this is not a stab to the heart. Collapsing his corporation, even if he can't access the small business tax rate, is unlikely to be the best strategy for Ken. While there is the potential for material consequence, so the new rules should not be ignored, there are also many options available to Jennifer and Ken to mitigate and or eliminate those consequences. As was already shown in the tax section, $50,000 per year of passive investment income is only a relevant figure to physicians who have active income in excess of $500,000 per year. Jennifer and Ken earn $350,000 per year. Even if all that active income applies, the relevant passive income number for them is 60% higher at $80,000 per year. To emphasize, $80,000 is the passive income level that begins to have an impact on their active income tax rate. In terms of mitigating or avoiding the consequences of the new passive investment changes, we're going to discuss three types of strategies. The first is how portfolio management can frequently make the finance 5% fully taxable return and $1 million portfolio irrelevant assumptions. The second is how other financial products can further reduce the impact. And lastly, we will outline how compensation decisions, including salary and/or eligible dividends, can also help. Let's start our portfolio management section by reaffirming that it is dangerous to let tax planning drive portfolio decision making. Eliminating income, generating losses, and increasing fees all could help with this new tax problem. But reducing investment performance brings with it greater negative consequences than the new tax rules. Accordingly, we are assuming continued effective portfolio management. Our focus is on why 5% fully taxable income will frequently be an irrelevant assumption due to return and tax realities. Consider the following. Anything that reduces the fully taxable nature of the 5% return helps. Three aspects in there. Number one, our current low interest rate environment means secure returns are often less than 3%. That usually holds true not only for bonds and GICs, but foreign income and dividends as well. Number two, unlike interest, foreign income, and dividends where the full amount applies, only 50% of capital gains is applied to the passive investment test. That means a higher capital return like 7% only counts as 3.5% against the test. Number three, furthermore, it is only the realized portion of the capital gains that counts, which means that if only a quarter of your capital gains are realized, that 7% return is reduced to a consequence of under 1% on the passive income test. Reevaluating how his portfolio reduces passive income will be high priority with Ken, as the benefit can be immediate. It will have low urgency with Jennifer, though, as the payoff for her is more than a decade in the future. Then there's the deduction side. Don't forget to net out your costs. If you're in a mutual fund, this likely happens automatically in your performance. Portfolio management fees, like with our discretionary service that are charged separately, actually work a little better under the new rules. Just make sure you don't forget to deduct them from your passive investment income as part of the test. Leverage costs could do the same thing, but with risk considerations that would need to be addressed. This probably isn't the highest priority, even for Ken, but deductions can prove useful in helping your portfolio avoid consequences on your active income. Looking at a portfolio example, 2017 was the latest in a sequence of good years for our portfolio management service. We found ways to generate significant income, as well as gains at relatively low costs. That's great for wealth generation and achieving goals. But let's explore what the impact would have been on access to the small business tax rate if the new rules applied. And just to reaffirm, they don't apply for 2017 passive income. This is just an example. The upshot is that the fully taxable equivalent rate to use was not 5%, it was 3%, even in that relatively good year. Since Jennifer and Ken only start to be impacted at $80,000 of passive income, dividing $80,000 by 3% means they could have a $2.65 million corporate portfolio without consequence. We have found many scenarios where the portfolio could be higher without consequence on small business tax rate access. For those who want or need further protection, let's move on to our second and third categories: other financial products and compensation strategies. RSPs require salary compensation, but have no upfront taxation. They could be used to shift 1/3 of Jennifer or Ken's yearly savings outside the corporation, frequently enhancing savings levels, plus possibly also furthering income splitting via spousal plans if Jennifer or Ken are married. TFSAs have an upfront tax cost, but with Jennifer's time horizon, she is better off making them even under existing rules. And doing so reduces the corporate portfolio, which helps under the new rules. They are still likely to be the right thing to do for Ken, but the contribution limits may be inadequate to address his immediate challenges. Contributions to a spouse's TFSA are permitted, so they may also be able to help with income splitting. Individual pension plans, or IPPs, are a good example of sheltering additional investment income outside the corporation. For physicians over age 40, especially those looking to protect conservative investments for retirement, an IPP can be better than RSPs in terms of sheltering investment income. And then there's permanent life insurance, the classic example for sheltering investment income inside the corporation. The key is to ensure the policy remains exempt from corporate taxation. That usually means these policies are estate planning stars under the current rules and are even more relevant under the new passive investment tests. Here's some practical examples. Jennifer has more time to work with, so let's focus on RSPs and TFSAs for her and her spouse. Contributions of $35,000 per year for 30 years at 5% would grow to $2.3 million. That's a portfolio not exposed to the new corporate passive investment rules. Ken has more immediate challenges, so we'll have a shorter time frame and be looking to more room to shelter income. So we'll consider IPPs and permanent life insurance for him. He probably can't protect millions up front, but contributions of $100,000 per year for 10 years at 5% grow to $1.25 million. RSPs, TFSAs, IPPs, and permanent life insurance aren't new strategies. But together, the diversification they offer could result in millions of dollars of additional investments that do not trip the new corporate passive investment rules. Between portfolio management and financial product possibilities, portfolios of several million dollars can commonly be protected. Let's add our third category and stretch the limits even further with salary and/or eligible dividend considerations. This might be called the accountant's quandary. Some will prefer using salary, others may prefer eligible dividends. It's important to be aware of the possibilities of both. Switching from dividends to salary lowers corporate income, which delays the impact of losing the small business rate and reduces the consequences. That is, if Jennifer or Ken were to switch from dividends to salary, they could reduce their corporate income applicable to the test from $350,000 to under $100,000. That would increase the threshold for passive income from $80,000 per year to $130,000 per year. That's another 60% plus increase in the size of the corporate portfolio that can be protected. And of course, this is also a precursor to RSP or IPP contributions, which we discussed earlier. Switching to eligible dividends immediately, once the consequences begin, can fix the lag in offsetting the increased corporate taxes with reduced personal taxes. Jennifer and Ken have personal income that is over $200,000 per year, which means their personal taxes are high, and integration should roughly balance those consequences. That is, if the corporation pays $13,000 more, but they pay $13,000 less personally, that's $0, as long as timing and tax rates are similar. This has marginal, if any, benefit to Jennifer, who is just getting started, but could feel like a lifesaver for someone with high corporate assets and passive income, but not yet ready to retire. The other box that considers structures or restructures. If Jennifer is in a province that permits a holdco to own shares of the Prof Corp, or corporate assets are pushed out to a trust, or gifted to a charity. Stay tuned. Additional work is needed on these, and there certainly can be increased risk. When you hear about creative strategies involving restructuring, keep in mind that the government's tolerance is low and anti-avoidance action is expected to be robust. Also keep in mind that these strategies are likely to be dynamic in terms of execution. Different solutions will be priorities at different times. Furthermore, more than one will often be in play at a time, and it may be necessary to adjust on the fly. Consider, what about a year with abnormally high income? A large triggered gain because an investment soars. time off for disability or sabbatical, changed views on debt, insurance, or risk tolerance. As annoying as this change might be, it really is good news that there are portfolio, financial planning, and accounting avenues available to mitigate the consequence of the new corporate passive investment rules. If you are caught, it should only be an exception circumstance where you are doing quite well, or in an unusual situation where the consequence could be only 1 year.
Great, thank you so much, Lowell. Now we're going to open it up for some questions.